Have you wondered which loan program is best for you? What's the difference between a conventional loan and FHA, USDA, and VA? USDA and VA are both zero down programs, but what do I need to qualify? Do you question what criteria makes one program more beneficial than another? Let's talk about it. Welcome back. I'm Lisa Pinnick of Lisa Does Loans and the Mortgage Dream Team with UFFC Express. I'm glad you're here. Last week, we talked about finding a realtor and starting the hunt for the home. The next step would be to make an offer on the home, but before your realtor can write up the offer, we need to know which loan program they're going to use. So let's talk about the most common loan programs that most people are eligible for, and most people are eligible for more than just one. It's our job to evaluate the data and your goals to determine which program is best for you and your situation. There are basically four loan types: conventional, FHA, USDA, and VA. The HUD 184 is specific to Native American borrowers, and it's actually a form of the FHA loan, but it comes with its own set of guidelines and benefits to Native American borrowers. Today, we'll talk about all five programs. There are specialty programs as well, but we'll talk about those later in the series. Today, I want to focus and compare and contrast on the most common loans used. Conventional loans are suitable for borrowers with strong credit and who have money for down payment. Down payment requirements start from 3% to 5%, but with a 20% down payment, mortgage insurance can be eliminated. There are no income restrictions on conventional loans. Mortgage insurance is only required if you are using a lower down payment less than 20%. But the good news is that when you use that lower percentage, when the equity of the home is 22%, the mortgage insurance falls off on its own. Standard FHA loans are ideal for those with less than perfect credit and limited down payment funds. FHA is the most forgiving if you have credit issues in your past, like foreclosure, bankruptcy, or late pays. Down payment is required at 3.5%. There are no income restrictions. There is an upfront fee that is a mortgage insurance premium of 1.75% of the loan amount. This can be financed into your loan amount, or it can be paid up front. And you will be required to pay mortgage insurance for the life of the loan as part of your monthly payment. As I mentioned, the HUD 184 loan is actually a type of FHA loan. It is not as forgiving as a standard FHA, but it has wonderful benefits for Native American borrowers. If you have collections, payoff is required before closing, and the credit score requirement is a little bit higher than standard FHA. However, you can benefit from a lower down payment of 2.25%, lower mortgage insurance requirements, and these loans typically have a great interest rate as well. These benefits can make your monthly payment lower. We'll show these programs side by side in just a moment so you can understand the pros and cons. Now, let's take a look at these programs side by side and discuss how we might look at these programs strategically for your particular scenario. Credit. If credit history or low score is an issue, it's easy to see that the FHA might be your best bet. But we should compare any loans that you qualify for to check for the best interest rate as well. While one would assume that the conventional loan always has the best rate, that isn't really true. And there is no hard and fast rule on which program will carry the best rate on any given day either. So, your Mortgage Dream Team is always going to make sure that we are considering all the options so that you can choose the best one for you. If you have outstanding collections or bad history, FHA will be your best bet. But remember, you will have to pay those off before using the HUD 184. So don't worry, we've got a video coming up in this series that goes deep into credit and things that you can do to be ready at application time. How much cash do you have on hand? It's easy to see in comparison that USDA or VA would be great options if cash to close is a concern because they have no down payment requirement. But we do have strategies to use for cash to close if USDA or VA is not an option. Conventional loans can be utilized with as little as 3% when you meet certain criteria. But if cost overall is your goal, a bigger down payment means less principal that you are paying interest on, and you can exclude that mortgage insurance, which can make your monthly payment much less between the two. Strategy is everything when we are deciding which loan program, but the Mortgage Dream Team is here to help with that. On income restrictions, conventional FHA and HUD 184 do not have a limit on your income for eligibility, but USDA does have a ceiling based on your family size and the county average income amounts. As I said moments ago, VA does also consider their residual income requirements, so that can be an income limitation. If your goal is less cost overall or versus cost to close, that can change the loan type that we consider the most beneficial for you. We might choose to avoid mortgage insurance, keeping your monthly payments lower, or consider one program versus another because of the impact on some of your specific details. This is one of the ways that your mortgage experience should be customized to you. Cost overall versus cost to close is unique to each person. If you don't have the money to spend, we can also consider going with a no or low down payment option for now and then refinance to get out of the mortgage insurance later. Mortgage insurance is just one way that we can strategize to prioritize cost overall versus cash to close depending on your priorities. While we're talking about strategy, let's dive a little deeper in this area. If you are worried about cash to close, you might want to know that there are other ways to cover these costs. Did you know that the sellers can cover a portion of your closing costs? There is a set maximum amount for each loan type based on the percentage of the purchase price. Conventional allows 3% with the maximum or the minimum down payment, but it can go up to 6% if you put 10% down, and if you put 25% down, it can go up to 9% of the purchase price for seller concessions. So we just need to do the math. FHA, USDA, and 184 all allow 6%, and VA is the one that's really fun. It's got a whole different set of standards on what can and can't be paid by the buyer and what they consider to be closing costs at all. While 4% might look like a smaller concession, sometimes it can end up being the very best option for our veteran borrowers. All of these programs have options for gifts from family, and all have options for down payment assistance programs. When we have our consultation, we can discuss all of these options, and of course, we'll address all of these individually in our series as well. Another item that can determine what loan program we ultimately use is the DTI, or debt to income ratio. Each program has its own guidance here, and many times this can be the deciding factor. If the home that you would like to make an offer on has a purchase price that makes your DTI too high, we might opt to go for a program with a less restrictive philosophy on the percentage you can use towards your income towards housing. Of course, the programs that have an income restriction as part of their guideline will have a lower threshold in this area. Of course, there are compensating factors that we can look for that may allow a higher DTI, and that's yet another reason that the consultation is so important. You can see by the chart that there are times that a borrower might qualify for conventional, but it would be a better option for them to go FHA. This can be confusing to some borrowers with really great credit because so many think of FHA as the program for credit impaired borrowers. And it is, but it also has a higher tolerance for debt to income, and many times it might have the better rate because of the government backing. There really is no best loan program. There's only the best program for you. How much are you wanting to borrow? That can also be a determining factor in the type of loan that we choose. If your loan amount is high, you might be better suited to a conventional or VA or a jumbo loan. We'll talk about that program later in our series, The county that you're buying in can also have an impact on which loan program is better for you. As you know, USDA isn't eligible in all areas. So if you're using the HUD 184 or the USDA, the county is important. If you were using an assistance program like Cherokee Nation MAP or another assistance program, those will only work in certain counties. So that property location has a direct bearing on which program is right for you. One fundamental aspect that often gets overlooked in the mortgage process is the significance of the subject property itself. We just spoke about the county's effect on the program, but it's important to know that it's not just about the borrower's financial standing. The property itself plays a pivotal role in determining the most suitable loan program. So let's delve into why the subject property holds such importance in this decision-making process. When it comes to a newer home, there isn't much to worry about when thinking about the appraisal, but if you're looking at an older home that might need a lot of repair, the type of loan you choose might have an appraisal as the top contributing factor. Conventional is the most lenient and forgiving. It has less regulations overall than the government loan types, and it might call for less required repairs to meet the standards. FHA, USDA, and HUD 184 all have the exact same guidelines, but they just use different forms by the appraiser. And VA has its own set of standards and uses a completely different set of appraisers than the other loan types. Another thing to keep in mind with those fixer-uppers is we do have renovation loans that are available as well, so that the repairs can be financed into the loan if you qualify. There are certain types of property that can't even use certain loan types. For example, if you're thinking about buying a second home or an investment property, you aren't able to use FHA, USDA, or HUD 184 at all. And with VA, there are some exceptions, but that's what we are here for, to look at your scenario and to find those exceptions and what program suits you best so that you get the very best deal for your particular circumstances and goals. So, as you can see, there are lots of concerns that go into choosing a loan program and lots of benefits and some drawbacks or considerations to consider with each type. When you apply with the Mortgage Dream Team, we will look at all those options and then go over them with you to match up your goals and what is most important to you. Next week, we'll pick up on after the contract and talk about those home inspections that may be required or a good idea when you go under contract on that home purchase. If you like this content, please give it a like and share. We would love it if you would subscribe to our channel as well. We're on Facebook, Instagram, and YouTube. Thank you so much for watching, and please give me a call or shoot a text or email if I can help you, or if you have questions or ideas for topics in this series that you want to know more about. The Mortgage Dream Team is here to help you, and it all starts with a conversation.